There is a dangerous lie at the heart of the stock market, a seductive whisper that has led more well-intentioned investors to ruin than perhaps any other single idea. It's a lie that looks like truth, feels like progress, and is celebrated on the front pages of financial newspapers. The lie is this: growth is always good. We are taught from our first lemonade stand that getting bigger is the goal. More customers, more revenue, more employees, more locations. Growth, we are told, is the sign of a healthy, thriving enterprise. And so, we hunt for it. We scour financial reports for companies whose sales are exploding, whose ambitions are grand, whose CEOs are announcing bold new expansions and billion-dollar acquisitions. We see a stock chart going up and to the right, fueled by a narrative of ever-increasing size, and we mistake that momentum for genius. We mistake activity for achievement. We mistake growth for value. And in doing so, we fall directly into a trap, a subtle but devastating financial pitfall that separates the amateur from the master, the 99% from the 1%. The trap is believing that all growth is created equal. Warren Buffett, the most successful investor in modern history, built a fortune of over $100 billion, not by chasing growth, but by understanding its true nature. He learned, often through painful experience, that some types of corporate growth are a cancer, a process that actively consumes shareholder capital and makes the owners of the business poorer with each passing year, even as the company's name gets bigger and its logo more prominent. He discovered that a company can grow itself straight into bankruptcy. Conversely, he found a rare breed of business, the true compounding machines, whose growth was not just growth, but an explosive chemical reaction that minted wealth for its owners on a scale that defies belief. The difference between these two paths, the empire-building, value-destroying path and the compounding value-creating path, is the single most important secret to successful long-term investing. It is the key to unlocking superior returns, to achieving genuine financial freedom, and to building a portfolio that doesn't just grow, but compounds with an unstoppable and magnificent force. Understanding this distinction is not just an intellectual exercise, it is a fundamental transformation in how you see the world of business and finance. It will equip you with a lens of clarity that cuts through the noise of market commentary and the hype of corporate press releases. You will learn to see not what a company says it is doing, but what it is actually accomplishing for its owners. Today, we are going to dismantle the lie of growth. We will build, from the ground up, the mental framework that allows you to differentiate between the growth that makes you rich and the growth that is simply a trap. This is the final promise of intelligent investing. Our journey begins with the most painful and potent teacher, failure. To understand the trap of illusory growth, we must first travel back in time, not to one of Buffett's celebrated triumphs, but to his most grueling and formative mistake. We must go to the bleak, windswept mill towns of New England in the mid-1960s to a company called Berkshire Hathaway. Today, that name is synonymous with unimaginable wealth and success, a holding company for some of the world's greatest businesses. But in 1965, Berkshire Hathaway was a dying textile manufacturer, a relic of a bygone era. When Buffett's investment partnership took control of the company, he was a young, brilliant investor who had mastered the art of buying statistically cheap cigar butt companies. Berkshire was one such cigar butt. It was trading for less than its working capital, a classic Graham and Dodd value play, but he soon found himself in a position he had never intended, running a business. And not just any business, but a terrible one. The American textile industry was in a death spiral. Competition from low-wage countries was relentless, and the industry was plagued by massive overcapacity. The only way to compete was on price, which meant margins were razor-thin or non-existent. Yet the industry was caught in a bizarre and destructive cycle. Every few years, a new, slightly more efficient loom or spinning machine would be invented. The logic seemed inescapable. To stay competitive, a mill had to buy this new equipment. The problem was, everyone did. All the mills would mortgage their futures to buy the new technology. The collective capacity of the industry would increase, and the resulting glut of fabric would drive prices down even further, completely wiping out any efficiency gains from the new machinery. It was a capital expenditure arms race to the bottom. The foundational anecdote of this first pillar is Buffett's decade-long struggle inside this economic furnace. He was the owner of a business that needed constant injections of capital just to stay in the game. He authorized millions of dollars in spending. In 1967 alone, he spent over $800,000 on new equipment. The company was growing its asset base. It was investing in the future. On paper, it looked like progress. But Buffett felt a sickening realization dawning on him. He was pouring good money after bad. Each dollar he reinvested into the textile business was like pouring water into a leaky bucket. He could spend $1 million on a new set of looms, and the return that capital would generate was pathetic, often less than the rate of inflation. He was running faster and faster on a treadmill that was tilted against him. The company might report a small profit in a good year, but that profit was immediately consumed by the need for more machines, more upgrades, more maintenance. The cash was trapped. In his 1985 letter to shareholders, looking back on this ordeal, he penned one of the most important paragraphs in financial history. He wrote, "It is important to understand that the textile business did not require any great genius to run. All that was required was the sort of ability that could be hired for very modest sums. The problem was that the business earned terrible returns on the capital invested in it. A horse that can count to 10 is a remarkable horse, not a remarkable mathematician. Likewise, a textile company that earns a few $1,000,000 is a remarkable textile company, not a remarkable business." That was the epiphany. Growth, in this context, was a mirage. Buying more looms, producing more yards of fabric. It was activity, it was expansion, but it was not creating any real, durable value for him as the owner. In fact, it was destroying it. Every dollar he reinvested in the textile mill at a 3% return was a dollar he could have invested in another business that earned 15%. The opportunity cost was staggering. This brutal hands-on experience forged his core principle, the crucial difference between growth that adds value and growth that is simply a result of reinvesting shareholder capital at low returns. The Berkshire Hathaway textile business was the ultimate empire builder, an enterprise that soaked up capital like a sponge and gave back almost nothing. It was growing, but it was making its owners poorer every day. This brings us to the underlying psychological principle that makes this trap so effective, a potent combination of action bias and the narrative fallacy. Our brains are not wired for patient inaction. In situations of uncertainty, we have a deep-seated bias towards doing something, anything, rather than nothing. This is action bias. A CEO who announces a $500 million factory expansion or a major acquisition is seen as decisive, bold, and visionary. A CEO who says, "Our business is generating a lot of cash, but we see no intelligent opportunities for reinvestment right now, so we're just going to sit on the money or give it back to shareholders," is often seen as timid, uninspired, or lacking a plan. We celebrate action, regardless of its underlying wisdom. This bias affects investors just as powerfully. We feel better when we are actively managing our portfolios, buying the hot growth stock, participating in the story of expansion. The quiet, steady compounding of a boring business feels less engaging. Complementing this is the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our minds crave stories. We weave disparate facts into coherent, emotionally satisfying narratives to make sense of the world. A story of a small company growing into a global behemoth is a powerful and archetypal narrative. We hear, revenue growth is up 50% year over year, and our brain immediately constructs a story of success, of momentum, of a future filled with promise. We fall in love with the story of growth and stop asking the hard, quantitative questions. Is this growth profitable? What was the cost of this growth? Is it creating value on a per-share basis? The narrative is so compelling that we ignore the numbers that contradict it. The CEO of the failing textile mill can spin a great story about investing for the future and modernizing our fleet, and both his board and the market will applaud the action. because the alternative, admitting the business is fundamentally broken, is a story no one wants to hear. So how do we break free from this psychological prison? We need an applied mental model, a blueprint for thinking that forces us to ignore the seductive narrative and focus on the cold, hard math of value creation. I call this model the "is the pie growing or just the slice count" framework. It's a simple three-step process to apply to any company you analyze. Step 1. Identify the cost of growth. When a company announces revenue growth, your first question must be, how much capital did they have to deploy to get that growth? Look at the balance sheet. Compare the total amount of capital invested in the business this year, which is roughly shareholders' equity plus total debt, to the amount from last year. Did they issue new stock? Did they take on more debt? Did they retain all their earnings? This increase in invested capital is the fuel for their growth. A company that grows revenues by $100 million after investing an additional $500 million is telling you a very different story than a company that achieves the same revenue growth with only a $50 million investment. Step 2. Calculate the return on the incremental tight capital. This is the crucial part. Take the increase in operating profit from one year to the next and divide it by the increase in invested capital you just calculated. This tells you the return the company is earning on the timed new nice money it is putting to work. This is the number that tells you if the growth is healthy or cancerous. Buffett was putting millions into the textile business, and the return on that incremental capital was horrifyingly low, sometimes negative. That is the signature of an empire builder. A true compounding machine, as we will see, earns fantastically high returns on the new capital it deploys. Step 3. Focus relentlessly on the per-share metrics. A company can grow its total earnings, but if it does so by issuing a massive number of new shares to pay for an acquisition, you, the individual shareholder, might not be any better off. The pie got bigger, but your slice got proportionally smaller. The ultimate litmus test is whether the intrinsic value per share is increasing over time. Look at metrics like earnings per share, free cash flow per share, and book value per share. Are these consistently going up? A CEO whose focus is on building an empire will celebrate total revenue and total profit. A CEO whose focus is on creating wealth for owners will talk obsessively about increasing the per-share value of the business. This mental model acts as a filter, shifting your focus from the headline number, total growth, to the number that actually matters, profitable, per-share growth. Now let's look at the antithesis, the path of the 99%. This is the road most investors travel, and it is paved with the wreckage of companies that pursued growth at any cost. The dot-com bubble of the late 1990s is the quintessential example. Companies like Webvan or Pets.com were lauded as paragons of the new economy. Their revenue growth was breathtaking. Webvan, an online grocery delivery service, was building a nationwide network of multi-million-dollar, highly automated warehouses. They were growing their asset base at a dizzying pace. Investors, captivated by the narrative of revolutionizing the grocery industry, poured billions into the company. They saw the growth and assumed success was inevitable. But they failed to apply the mental model. They never asked, what is the return on this massive investment in capital? The answer was horrifying. Each new warehouse, each new delivery truck, was a financial black hole, consuming far more capital than it could ever hope to generate in profit. The company was growing, but it was actively incinerating shareholder wealth with every single delivery it made. The 99% bought the story. They saw the top-line revenue growth and extrapolated it into the future, ignoring the catastrophic unit economics. The result? A spectacular bankruptcy and a total loss for shareholders. This pattern repeats in every market cycle. Think of the shale oil boom a decade ago, where companies took on mountains of debt to drill new wells, celebrating production growth while generating negative free cash flow year after year. Or consider the countless biotech or tech startups today that achieve massive user growth but have no clear path to profitability, surviving only by constantly issuing new shares and diluting their existing owners into oblivion. The path of the 99% is to be seduced by the siren song of revenue growth, to fall for the narrative, and to ignore the brutal mathematics of capital returns. This leads us to the direct financial connection. How does this principle of good growth versus bad growth manifest on a company's financial statements? It all comes down to the creation or destruction of intrinsic value. Imagine a business with $100 million of equity capital. Its cost of capital, what it could reasonably earn in a passive investment or what its shareholders expect, is 10%. In year one, the business earns a 5% return on its equity, generating $5 million in profit. This is already a poor business, as it's earning less than its cost of capital. Now the CEO faces a choice. He can pay that $5 million out to shareholders as a dividend. In this case, the shareholders receive their cash, and the business remains a mediocre one with $100 million in equity. But the CEO is ambitious. He wants to grow. He decides to retain the $5 million and reinvest it back into the business, in projects that also earn a 5% return. The company now has $105 million in capital. Next year, it earns 5% on this larger base, generating $5.25 million in profit. The company is bigger. Its assets have grown. Its total profits have grown. The CEO can issue a press release celebrating this growth. But what has happened to the owners? They have been forced to reinvest their $5 million at a 5% return when they could have taken it as a dividend and invested it elsewhere for a 10% return. The CEO has effectively destroyed half the value of that retained profit. The intrinsic value of the business, which is the present value of its future cash flows, has actually declined. By pursuing this value-destroying growth, the company is on a slow path to liquidation. This is how growth makes you poorer. Conversely, a company that earns 20% on its equity and retains its profits to reinvest in projects that also earn 20% is performing a miracle of financial creation. Every dollar it retains is instantly compounded at a rate far above its cost of capital, causing the intrinsic value per share to explode upwards over time. This is the engine of all great fortunes in the stock market. It's not just about growth. It's about the rate of return that growth is built upon. To achieve this kind of miraculous value-creating growth, a company needs a secret weapon, an invisible shield that protects it from the brutal forces of competition. This brings us to our second pillar, the economic moat, as the foundation of profitable growth. You simply cannot generate high returns on capital over any sustained period unless you have a durable competitive advantage. A business without a moat is a sitting duck. Any success it has will immediately attract competitors who will flood the market, drive down prices, and erode profitability until the returns are mediocre at best. Growth in a moatless business is almost always value-destroying because it requires pouring capital into a commodity-like operation where competition ensures returns will always be low. True compounding machines, therefore, are built on the bedrock of a deep, wide, and enduring economic moat. The foundational anecdote that best illustrates this principle is one of Buffett's most cherished acquisitions, See's Candies. In 1972, Buffett and his partner, Charlie Munger, were offered the chance to buy a family-owned, California-based chocolate company. On the surface, it didn't look like a typical Buffett investment of the time. It wasn't a statistically cheap cigar butt. The See family was asking for $25 million, which was a significant premium over the company's tangible assets of only $8 million. Buffett was hesitant. His nature was to buy things cheap. But Munger pushed him. Munger saw something that wasn't fully reflected on the balance sheet, a truly formidable economic moat. See's Candies had been a California institution since 1921. For decades, customers had bought See's chocolates for holidays, birthdays, and special occasions. The act of giving a box of See's was imbued with warmth, nostalgia, and affection. When a young man went to meet his girlfriend's parents for the first time, he brought a box of C's. This brand loyalty, built over half a century, gave the company a phenomenal competitive advantage: pricing power. Buffett realized that C's could raise its prices by 10% every year, and no one would bat an eye. Customers were not just buying chocolate, they were buying a trusted brand and the happy emotions associated with it. They were not going to switch to a cheaper, unknown brand to save $1 or $2 on a Valentine's Day gift. This pricing power meant that C's could generate spectacular returns on its capital. And here was the most beautiful part: the business required almost no capital to grow. The growth came from price increases and the opening of a few new stores, all of which could be funded easily from the company's own earnings. It was the polar opposite of the Berkshire textile mill. The mill needed constant, massive infusions of capital just to survive. C's Candies was a gusher of cash that required almost nothing to be put back into it. Since acquiring it for $25 million, Berkshire Hathaway has received over $2 billion in pre-tax profits from C's, and that number continues to grow. It was a business with a powerful brand moat that allowed for decades of high-return, capital-light growth. It was Munger's lesson to Buffett: it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The source of that wonder is the economic moat. The psychological reason we so often overlook the importance of moats is a fascinating interplay of the Lindy effect and our obsession with novelty. The underlying psychological principle here is that we systematically undervalue the old and overvalue the new. The Lindy effect is the observation that for certain non-perishable things, like technologies or ideas, every day they continue to exist implies a longer remaining life expectancy. A book that has been in print for 100 years is more likely to be in print in another 100 years than a book that was just published yesterday. The same is true for brands and business models. C's Candies had been around for 50 years when Buffett bought it. That half-century of survival was a powerful indicator of its durability. It had weathered depressions, wars, and changing consumer tastes. Its brand had proven its staying power. This is a form of social proof on a grand, multi-generational scale. People trust it because their parents and grandparents trusted it. Yet as investors, we are constantly drawn to the new, the disruptive, the revolutionary. A company with a flashy new technology and a promise to change the world is far more exciting than a 100-year-old chewing gum company. We overestimate the probability that the new thing will succeed and underestimate the resilience of the old established player. We mistake the rapid growth of a fad for the sustainable growth of a fortress. Buffett's genius is in his ability to ignore the siren song of the new and focus on the time-tested power of durable competitive advantages. He understood that the Lindy effect was a powerful tailwind for a business like C's or Coca-Cola, while it was a brutal headwind for a technology company with no proprietary advantage. To systematically identify these advantages, we need an applied mental model, a checklist to guide our analysis. The moat identification checklist is a practical tool for any investor. It breaks down the concept of a moat into 5 primary sources. First, intangible assets. This includes brands, patents, and regulatory licenses. A brand like C's or Coca-Cola creates an emotional connection with consumers that allows for premium pricing. A patent gives a pharmaceutical company a temporary monopoly. A government license to operate as a credit rating agency, like Moody's has, is an enormous barrier to entry. Ask yourself, does this company have a name or a legal right that is difficult or impossible for a competitor to replicate? Second, switching costs. These are the costs or hassles a customer would face if they were to switch from the company's product to a competitor's. Think of a bank. Moving your checking account, direct deposits, and automatic bill payments is a massive pain. This inertia keeps customers locked in, even if a competitor offers a slightly better interest rate. Enterprise software companies are masters of this. Once a corporation runs its entire operations on Oracle or SAP software, the cost and risk of switching to a new system are astronomical. Ask, would it be genuinely painful for a customer to leave this company? Third, network effects. This is when a product or service becomes more valuable as more people use it. The classic examples are telephone networks or social media platforms like Facebook. The first telephone was useless. The billionth telephone was incredibly valuable because it could connect to all the others. A credit card company like American Express has a network effect. More merchants accept it because more cardholders have it, and more cardholders get it because more merchants accept it. This creates a powerful, self-reinforcing loop. Ask, does the value of this service increase for every new user that joins? Fourth, cost advantages. This is the ability to produce a product or service at a lower cost than competitors. This can come from scale, like Walmart's massive purchasing power, or from a unique process or geographic advantage, like Geico's direct-to-consumer insurance model, which bypasses costly agents. The low-cost producer in a commodity industry is the only one who can survive a price war. Ask, does this company have a structural advantage that allows it to consistently undercut its rivals on price while still maintaining profitability? Fifth, and finally, ask about the durability of these advantages. Is this a moat that is widening or shrinking? A patent expires. A brand can be damaged. A new technology can render a network obsolete. The best investments are in companies with deep moats that are actively getting wider over time. The antithesis, the path of the 99%, is to mistake a temporary advantage for a durable moat. This is one of the most common and costly mistakes in growth investing. A company develops a hot new product, and its sales go through the roof. Think of GoPro with its action cameras, or Fitbit with its fitness trackers. For a brief period, these companies looked like unstoppable growth machines. They had phenomenal revenue growth, and the market awarded them dizzying valuations. But the 99% investor failed to ask the crucial question: what is stopping someone else from making a similar product? They mistook a first-mover advantage and a cool product for a real economic moat. In both cases, the answer was nothing. There were no significant patents, no real switching costs, and no network effects. As soon as their success became obvious, competitors flooded the market. Larger companies like Apple, with its vast resources and ecosystem, incorporated the core features of these products into their own, essentially crushing the originals. The high margins and rapid growth that investors had extrapolated into the future vanished. The stocks collapsed, wiping out fortunes. The 99% buys the story at the peak of its popularity, mesmerized by the growth, without ever conducting the rigorous moat analysis that would have revealed the business was built on sand, not rock. They buy the fad, not the fortress. The direct financial connection between a strong economic moat and a company's financials is immediate and obvious. You see it most clearly in the company's profit margins. A business with a wide moat, particularly one based on a strong brand or high switching costs, has pricing power. It can raise prices year after year to offset inflation and increase its profitability. A business in a competitive, moatless industry has no pricing power. It is a price taker, not a price maker. This difference is starkly visible on the income statement. Look at the gross margins and operating margins of a company over a 10-year period. A company with a moat, like Microsoft or Moody's, will have high and remarkably stable, or even rising margins. They are protected from the ravages of price competition. Now look at a company in a commodity industry, like an airline or a basic materials company. Their margins will be thin and wildly volatile, swinging dramatically based on the economic cycle and the actions of their competitors. A moat provides a buffer of profitability that allows a company to not only survive tough times, but to thrive and generate the excess cash needed for intelligent capital allocation. This sustained high profitability is the fuel for the engine of compounding. Without the moat, the fuel tank is always running on empty. A moat is not just a nice qualitative feature. It is a quantitative reality that translates directly into superior financial performance and ultimately massive shareholder value. So, we have established that profitable growth requires a moat. But how do we measure the quality of that growth in a single, powerful metric? This brings us to our third pillar, the financial heart of our entire framework, the litmus test, return on invested capital, or ROIC. If the economic moat is the qualitative foundation of a great business, ROIC is its quantitative scorecard. It is the single best measure of how effectively a company is using its capital to generate profits. It cuts through all the accounting noise and answers the fundamental question: for every dollar invested in the business, how many cents of profit does it generate each year? A company that can consistently generate a high ROIC is a company that has a strong moat and is creating significant value. A company with a low ROIC is, by definition, a poor business, and any growth it pursues is likely to be the value-destroying kind we saw with the Berkshire textile mill. Mastering this one metric will elevate your stock analysis from amateur to professional. The foundational anecdote that perfectly captures the power of ROIC is Warren Buffett's landmark investment in the Coca-Cola Company in 1988. At the time, the market was still reeling from the crash of 1987, and many were skeptical of Buffett's decision to invest over $1 billion, a huge portion of Berkshire's capital, into a single stock. But Buffett wasn't looking at the market's mood. He was looking at the economics of the business through the lens of ROIC. What he saw was a business model of almost unparalleled genius. Coca-Cola itself didn't bottle the soda. It didn't own the trucks or the factories. That was the job of its vast network of independent bottlers. The bottlers owned the capital-intensive, low-margin part of the business. Coca-Cola's role was elegantly simple. It created the secret syrup concentrate in its own plants and sold it to the bottlers. And it managed the brand's marketing globally. This was a business that required astonishingly little capital, a few concentrate plants, and a marketing budget. For every dollar of capital invested in its own operations, Coca-Cola generated enormous profits. Its return on invested capital was consistently over 30%, a truly staggering number. Furthermore, its growth was also capital light. As Coke expanded around the world, it didn't need to build billions of dollars worth of factories in every country. It simply signed up new bottling partners who would put up the capital, while Coke just shipped them more of its high-margin syrup. Buffett saw a company that was not just growing, but growing in a way that produced spectacular returns on every incremental dollar invested. It was the perfect compounding machine. The market was worried about short-term issues, but Buffett was focused on the unassailable mathematics of a high ROIC business expanding its footprint across the globe. The investment became one of the most successful of his career, a testament to the power of identifying a business with a world-class moat that manifested itself in a world-class return on invested capital. The reason most investors ignore this critical metric lies in a cognitive bias known as the availability heuristic. This is the underlying psychological principle at play. Our brains tend to make judgments based on information that is easily recalled or readily available, rather than seeking out more complex but more relevant data. Metrics like revenue growth and earnings per share (EPS) are everywhere. They are in the headlines of every financial news article. They are the first numbers you see on any stock quote page. They are simple, digestible, and readily available. Calculating ROIC, on the other hand, requires a little more work. You have to dig into the balance sheet and the income statement. You need to understand concepts like net operating profit after tax, NOPAT, and invested capital. Because it's less available and requires more mental effort, most investors simply don't bother with it. They default to the easier, more prominent metrics, even though those metrics can be profoundly misleading. A company can grow its EPS simply by taking on a lot of cheap debt and buying back its own stock, a financial engineering trick that doesn't necessarily indicate an improvement in the underlying business. Revenue growth, as we've seen, says nothing about profitability. ROIC, in contrast, cannot be easily manipulated. It is a pure, unvarnished measure of a business's economic engine. By succumbing to the availability heuristic, the 99% of investors focus on the speedometer, revenue growth, and the odometer, total earnings, while the professional investor is focused on the fuel efficiency gauge, ROIC. Let's translate this into an applied mental model, a practical blueprint for calculating and using ROIC. We'll call it the ROIC versus WACC hurdle rate method. It's a two-part process. First, you calculate the ROIC. The formula is NOPAT divided by invested capital. Let's break that down. NOPAT, or net operating profit after tax, is the company's operating profit with taxes taken out. It shows you the profit generated from the core business operations before any effects of debt or financing. To get it, you typically take earnings before interest and taxes (EBIT) from the income statement and multiply it by the tax rate. Invested capital is the total amount of money that has been put into the company to fund its operations. The simplest way to calculate it is to take total equity from the balance sheet and add the company's total debt, then subtract any cash that isn't essential for operations. This represents the pool of capital that management is responsible for generating a return on. Divide your NOPAT by your invested capital, and you have your ROIC. For example, if a company has a NOPAT of 20 million and an invested capital of 100 million, its ROIC is 20%. Now for the second part, comparing it to the WACC. WACC stands for Weighted Average Cost of Capital. This is a crucial concept. It represents the blended cost for the company to finance itself, considering both its debt and its equity. Think of it as the minimum return the company must earn on its investments just to break even for its investors. Calculating WACC can be complex, but for our purposes, a good rule of thumb is to use a general number like 8 to 10%, which represents the historical average return of the stock market. This is the hurdle rate. The mental model is simple. A company only creates value when its ROIC is significantly and consistently higher than its WACC. A company with a 20% ROIC and a 10% WACC is a value-creating machine. A company with a 5% ROIC and a 10% WACC is a value-destroying empire builder, no matter how fast its revenues are growing. This framework gives you a definitive, data-driven way to judge the quality of any business. The antithesis, the path of the 99%, is to praise and invest in capital-intensive growth. These are the industries that are notorious for their low returns on capital. The classic example is the airline industry. An airline can grow by buying more airplanes. A single modern jetliner can cost over $100 million. It's a massive capital expenditure. The 99% investor hears a headline: United Airlines orders 100 new Boeing 737s, and their brain immediately thinks growth, expansion, modernization. They see it as a sign of strength and confidence, but the sophisticated investor who understands ROIC asks a different question. What is the return that each of those new $100 million assets will generate over its lifetime? When you factor in fuel costs, maintenance, labor, gate fees, and brutal price competition, the return on that invested capital is often pitifully low, frequently falling below the cost of capital. The growth is real, but it's profitless, value-destroying growth. The company gets bigger, but the owners get no richer. This is true for many heavy industries: steel mills, auto manufacturing, shipbuilding. They are locked in a constant cycle of massive capital investment for meager returns. The 99% investor gets excited by the tangible nature of the growth, the new factory, the new fleet of planes, but they fail to see the invisible truth on the balance sheet, that this growth is consuming capital at a rate that destroys long-term shareholder value. The direct financial connection between ROIC and shareholder wealth comes down to one of the most beautiful concepts in finance: free cash flow. A company's ability to generate cash that is truly free and clear after all necessary investments in the business have been made is what ultimately determines its value. High ROIC is the magic ingredient for producing massive free cash flow. Let's use a simple example. Company A has an ROIC of 25%. Company B has an ROIC of 5%. Both companies want to grow their profits by 5% next year. To achieve this, Company A only needs to reinvest 20% of its operating profit back into the business. Because 20% of its profit reinvested at a 25% return yields the desired 5% growth. This means that 80% of its profit is left over as free cash flow, which can be used to pay dividends, buy back stock, or make acquisitions. Now look at Company B. To achieve the same 5% growth with its pathetic 5% ROIC, it must reinvest 100% of its profits. Because 100% of its profit, reinvested at a 5% return, is needed to get 5% growth, this company generates zero free cash flow. It is growing, but it is a slave to that growth. It is constantly force-feeding its own profits back into its low-return operations just to stand still relative to its growth targets. Company A, the high ROIC business, is a fountain of cash for its owners. Company B, the low ROIC business, is a capital desert. This is the ultimate financial payoff. High ROIC directly translates into oceans of free cash flow, and it is that cash flow that ultimately funds your returns as an investor, creating true portfolio growth and long-term wealth. Even a business with a magnificent moat and a high return on invested capital can be a terrible investment if the person at the helm is a fool. A great business is a powerful engine, but the driver still has to know where to go. This brings us to our fourth pillar, capital allocation, the CEO's true masterpiece. Once a business generates that precious free cash flow we just discussed, its leadership faces a critical set of choices. What should they do with this money? The decisions they make in answer to this question will have a more profound impact on long-term shareholder returns than almost any other aspect of the business. A brilliant operator can create a great business, but it is the master capital allocator who transforms a great business into an exceptional investment. The CEO's primary job is not to run the day-to-day operations. It is to deploy the company's capital at the highest possible rates of return over the long term. This is the CEO mindset that separates the good from the legendary. The foundational anecdote for this pillar is the story of a man Warren Buffett has called the greatest manager and capital allocator of the modern era, Tom Murphy of Capital Cities/ABC. Murphy was not a media mogul in the traditional sense. He was not a flashy programmer or a charismatic broadcaster. He was a rational, disciplined, and shareholder-focused executive who understood that his job was to convert media properties into cash flow machines and then reinvest that cash with ruthless intelligence. Starting with a single bankrupt television station in Albany, New York in 1954, Murphy and his partner Dan Burke built a media empire over 4 decades. Their formula was simple and devastatingly effective. They would acquire broadcasting stations or newspapers, businesses that had local moats and strong cash flow characteristics. Then they would operate these businesses with an almost fanatical focus on cost control and efficiency, maximizing the cash they produced. The key to their genius, however, was what they did next. They took the torrent of cash generated by their existing properties and used it to make more astute acquisitions, always paying a sensible price and always focusing on the return the new investment would generate. They were patient, waiting years for the right opportunity, and then they were bold, as evidenced by their shocking $3.5 billion acquisition of the much larger ABC network in 1985. Every decision was filtered through the lens of capital allocation. Will this move generate a high return on our invested capital for our shareholders? There was no ego, no desire for empire for its own sake. In his shareholder letters, Buffett would hold up Murphy as the platonic ideal of a CEO. He ran a decentralized operation, trusting his managers to run their businesses, while he focused on the one thing that mattered most, taking the pile of cash they generated and putting it to work in the most intelligent way possible. The culmination of this masterpiece of capital allocation came in 1995, when they sold the entire Capital Cities/ABC empire to Disney for $19 billion, completing one of the most staggering records of wealth creation in corporate history. Tom Murphy was the living embodiment of the CEO as a master capital allocator. Why are executives like Tom Murphy so rare? The answer lies in the underlying psychological principle. a toxic brew of the overconfidence bias and the agency problem. CEOs, by their very nature, are driven, optimistic individuals. They have risen to the top of their organizations because of their belief in their own abilities and the future of their companies. This can easily morph into overconfidence bias, where they systematically overestimate the chances of success for their own pet projects and acquisitions while underestimating the risks. They fall in love with their own ideas. A CEO might see a potential acquisition and convince himself that his brilliant management team can fix its problems and create synergies, a word that should set off alarm bells for any investor. The data shows that the vast majority of large corporate acquisitions fail to create value for the acquiring company's shareholders. Yet CEOs keep doing them year after year, fueled by overconfidence. This is compounded by the agency problem. In theory, a CEO is an agent who works for the owners of the company, the shareholders. In practice, their incentives are often misaligned. A CEO's pay, power, and prestige are often tied to the size of the company they run, not its profitability or per-share value. This creates a powerful incentive to grow the empire, even if that growth is unprofitable. Making a huge, headline-grabbing acquisition feels good. It puts the CEO on the cover of magazines. It expands their domain. Quietly buying back the company's own stock or paying a special dividend is far less glamorous. This misalignment between the agents, the CEO's incentives, and the principals, the shareholders' interests, leads to countless decisions that grow the company but shrink the owner's wallet. To combat this, we need an applied mental model to judge a CEO's capital allocation skill from the outside. The 5-option capital allocation checklist is the perfect tool for this. When a company generates excess cash, the CEO has 5 fundamental choices. Your job as an analyst is to look at the company's history and evaluate how its management has made these choices in the past. The 5 options are: 1. Reinvest in the core business. This is the best option, but only if the business can generate high returns on that incremental capital. A CEO who pours money into a business with a 5% ROIC is making a mistake. A CEO who reinvests in a business with a 30% ROIC is creating immense value. 2. Acquire other businesses. This is the riskiest option. You must ask, did they overpay? Is the acquired business within their circle of competence? Does it have a moat? Did the promised synergies ever materialize? 3. Pay down debt. This is a sensible and conservative option, especially if interest rates are high. It strengthens the balance sheet and reduces risk. 4. Pay a dividend. This is a direct return of capital to shareholders. It is an honest admission by management that they cannot reinvest the cash at a sufficiently high rate of return themselves, so they are giving it back to you to invest as you see fit. 5. Buy back shares. This can be the best option or the worst, depending on one thing: the price. A CEO who buys back stock when it is trading below its intrinsic value is creating enormous value for the remaining shareholders. It's like buying a dollar bill for 80 cents. A CEO who buys back stock when it is overpriced is destroying value just as surely as if they lit the cash on fire. By analyzing a CEO's 10-year track record against these 5 options, you can get a very clear picture of their skill. Do they have a rational, consistent, and value-oriented framework for deploying capital, or are they simply chasing growth for growth's sake? Their past actions are the best predictor of their future performance. The antithesis, the path of the 99%, is to fall for the diversification CEO. This is the executive who presides over a wonderful core business, and then, drunk on success and cash, decides to expand into areas they know nothing about. The history of business is littered with these cautionary tales. It's the story of a highly profitable software company deciding to buy a struggling hardware manufacturer, or a successful beverage company buying a movie studio. The most infamous example is the disastrous 2001 merger of AOL, the king of the dial-up internet era, with Time Warner, the media and entertainment giant. The CEOs sold it to the world as a visionary combination of new media and old media. It was going to be an unstoppable force, but it was a classic case of diversification. The cultures clashed, The promised synergies were a fantasy, and the business models were fundamentally incompatible. The merger was an unmitigated disaster that destroyed hundreds of billions of dollars in shareholder value. The 99% investor bought the hype. They listened to the grand pronouncements of the CEOs and believed the narrative of a new media empire. The sophisticated investor would have applied the capital allocation checklist and seen the red flags. AOL was using its massively overvalued stock as currency to buy a completely different type of business, in a deal driven by ego and a flawed vision of the future. It was a textbook example of a value-destroying capital allocation decision on a monumental scale. The direct financial connection of a CEO's capital allocation skill is most powerfully measured by its impact on shareholder yield. This is a metric that combines the company's dividend yield with its buyback yield, the percentage of its market cap it spent on repurchasing shares. It represents the total direct return of capital to shareholders. A skilled capital allocator will use buybacks opportunistically when the stock is cheap, which dramatically increases the long-term returns for the shareholders who stick around. For example, if a company has 100 shares outstanding and earns $100 in profit, its EPS is $1. If the CEO uses excess cash to buy back 10 of those shares when they are undervalued, there are now only 90 shares outstanding. The next year, if the company earns the same $100, the EPS is now $1.11, an 11% increase without the business itself having to grow at all. This is a powerful, tax-efficient way to increase per-share value. A clumsy CEO will do the opposite. They will issue new shares to pay for an overpriced acquisition, diluting the existing shareholders. Let's say in that same company, the CEO issues 10 new shares to buy a bad business. Now there are 110 shares outstanding. If the company still earns $100, the EPS falls to just 91 cents. The CEO's decision has directly made every shareholder poorer on a per-share basis. By tracking the company's share count over time and analyzing the price at which buybacks or issuances were made, you can see the tangible financial result of the CEO's capital allocation choices. Great allocators shrink the share count when the stock is cheap. Poor allocators grow it at the worst possible times. We have now assembled the core components of our framework. We know to avoid the trap of illusory growth. We know that true value-creating growth is built on the foundation of an economic moat. We have a quantitative litmus test, ROIC, to measure the quality of a business. And we know to bet on CEOs who are master capital allocators. Our fifth and final pillar is to put it all together, the compounding machine in action, from theory to portfolio. This is where we synthesize these concepts into a coherent whole and see what it looks like when a company embodies all of these principles. This is the process of identifying the true world-class compounding machines that can form the bedrock of a successful long-term investing strategy. Our foundational anecdote here is not one of Buffett's own direct investments, but a company that perfectly exemplifies the entire system, a discovery made famous by one of his philosophical disciples. The company is NVR Inc., a home builder. Now, at first blush, home building sounds like a terrible business. It's cyclical, capital-intensive, and highly competitive. All the hallmarks of a low ROIC industry. Most home builders operate on a land and expand model. They buy huge tracts of land, spend millions developing it with roads and utilities, build a bunch of houses on speculation, and then hope people will buy them. This ties up enormous amounts of capital for long periods and exposes them to huge risks if the housing market turns down. They are constantly betting the farm. But NVR, under the leadership of its brilliant founder, Dwight Scharre, developed a radically different, capital-light business model. NVR doesn't buy the land. Instead, it uses options to control lots from land developers. It pays a small deposit, say 10% of the land's value, for the right to buy that land at a future date at a preset price. Then, NVR pre-sells the house to a customer. Only after they have a firm contract and a down payment from a buyer do they exercise their option, buy the single lot, and build the house. This model is pure genius. It shifts the massive capital cost and risk of land ownership onto the developers. NVR's invested capital is incredibly low. It consists mainly of a few model homes and the deposits on the land options. This business model is a unique and powerful economic moat. It allows NVR to generate spectacular returns on its capital. While its competitors struggle to earn 10% on their capital in a good year, NVR has consistently generated returns on capital of 30%, 40%, or even higher. It is a compounding machine hidden in a terrible industry. And its management has been brilliant at capital allocation, consistently using the massive free cash flow generated by its model to buy back its own shares at attractive prices, shrinking its share count by over 70% over the last 2 decades. NVR is the perfect synthesis of all our pillars, a unique business model creating a moat leading to sky-high ROIC managed by brilliant capital allocators. It is a true compounding machine in action. The final psychological principle we must harness to put this system into practice is the commitment and consistency bias. This is our tendency to want to act in ways that are consistent with what we have already said or done. Now that you have invested this time to learn this entire, interconnected framework for analyzing businesses, a part of your brain has committed to it. You have seen the logic, you have understood the principles. The natural next step, to remain consistent with this new knowledge, is to apply it. The purpose of this final pillar is to solidify that commitment, to turn this passive knowledge into an active, lifelong skill. By summarizing the complete system, we are creating a mental touchstone that you will feel an internal pressure to adhere to. This bias, which often leads us astray, can be harnessed for good. It will create a healthy discomfort when you are tempted to revert to your old way of thinking, chasing a hot story stock or being seduced by simple revenue growth. Your brain will now say, wait, this is not consistent with the framework of moats, ROIC, and capital allocation that I know is superior. This internal consistency check is the final piece of psychological armor you need to become a truly disciplined and successful long-term investor. So let's create our final applied mental model, the compounding machine scorecard. This is a practical, unified checklist you can use to analyze any potential investment. It distills our entire discussion into 5 key areas, which you can score on a scale of 1 to 5. 1. Moat quality. How strong and durable is the company's competitive advantage? Use the 5 moat sources: intangibles, switching costs, network effects, cost advantages, to make your judgment. A 5 is a Coca-Cola or a Moody's. A 1 is a commodity business with no pricing power. 2. Historical ROIC. What is the company's 10-year track record of generating returns on invested capital? Is it consistently high, above 15 to 20%, and stable? A 5 is a company like NVR. A 1 is an airline or steel mill. 3. CEO capital allocation record. How has management deployed cash in the past? Have they been disciplined, rational, and shareholder-focused? Use the 5-option checklist. A 5 is a Tom Murphy. A 1 is the CEO who did the AOL Time Warner deal. 4. Balance sheet strength. How much debt does the company have? Can it withstand a recession? A strong balance sheet provides staying power and flexibility. A 5 has little to no debt. A 1 is dangerously leveraged. 5. Valuation. Even the world's best business is a bad investment if you overpay for it. Is the stock priced for perfection? Or is it trading at a reasonable price that provides a margin of safety? A 5 is a fair or even cheap price. A 1 is a nosebleed valuation that assumes decades of flawless execution. This scorecard provides a structured, rational process for stock picking. It forces you to think like a business analyst, not a market speculator. Companies that score highly across the board are the rare compounding machines you are looking for. And finally, we must understand the antithesis, the last great enemy of the rational investor, the story stock trap. This is where the narrative fallacy comes back with a vengeance. A story stock is a company, often in a new and exciting industry like electric vehicles, artificial intelligence, or genomics, that has a world-changing narrative. The story is so compelling, so visionary, that investors fall in love with it. They buy into the dream. The problem is that the story is often completely detached from the financial reality. These companies may have no moat, no profits, and a business model that requires endless infusions of new capital just to survive. They are the polar opposite of a compounding machine. They are capital incinerating machines. Investors in story stocks ignore all the metrics we've discussed. They don't care about ROIC because there are no returns. They don't care about capital allocation because the only allocation is spending the money they raise from selling more stock. They are purely betting on the narrative coming true someday in the distant future. This is not investing. It is speculation. The 99% are drawn to these story stocks like moths to a flame because they offer the intoxicating promise of getting in on the ground floor of the next big thing. But for every one that succeeds, 1,000 others fail, taking their investors' capital with them. The disciplined investor, armed with the compounding machine scorecard, can see these traps for what they are: financially hollow shells wrapped in a beautiful story. The direct financial connection that summarizes our entire journey is the long-term divergence between a company's stock price and its intrinsic value per share. Imagine two lines on a chart over a 20-year period. For a true compounding machine, the line representing its intrinsic value per share moves steadily upward and to the right, fueled by high returns on capital and intelligent reinvestment. The stock price line will be much more volatile, zigging and zagging with the market's manic depressive moods. But over the long run, like a dog on a leash, the stock price will inevitably follow the direction of that rising intrinsic value. Your job as an investor is simply to buy when the stock price is at or below the intrinsic value line and hold on as it grows. Now imagine the chart for an empire builder. The intrinsic value line is flat, or more likely, trending slowly downward as its low return growth erodes value. The stock price line might have moments of great excitement and hype, soaring far above the value line, fueled by a good story. But eventually, gravity always wins. The price will ultimately crash back down to reflect the poor underlying economics of the business. This chart is the final, visual proof of our thesis. Your financial transformation comes from learning to ignore the noisy, erratic stock price line and focusing with laser-like intensity on the smooth, predictable trajectory of the intrinsic value line. Find the businesses where that line is heading powerfully upwards, and you will have found the secret to beating the market and achieving true, lasting wealth. You have just been given a powerful and sophisticated tool. You've journeyed through the painful lessons of the textile mills, you've unlocked the secrets of See's Candy's moat, you've mastered the mathematical precision of return on invested capital, and you've learned to spot the genius of a master capital allocator. You now possess a complete framework for distinguishing between the growth that enriches and the growth that deceives. This is no small thing. This mental model is a permanent upgrade to your financial software, an asset that will pay dividends for the rest of your investing life. But it's crucial to understand that what you've just mastered, as powerful as it is a single critical piece of a much larger intellectual machine. The complete system of thought that someone like Buffett uses to analyze the world is a network of interconnected mental models. The framework for judging business quality is one part, but it connects to other models for understanding market psychology, for calculating valuation, for assessing risk, and for managing one's own behavioral biases. Each model reinforces and strengthens the others, creating a latticework of wisdom that is exponentially more powerful than any single part in isolation. You have just forged a vital link in that chain, but the chain is not yet complete. The video that is now appearing on your screen is not a random suggestion. Think of it as the next piece of the map, the adjacent link in the chain you have just begun to build. It is the component designed to connect to the knowledge you have just acquired, to deepen your understanding of how these powerful business principles intersect with the often irrational behavior of the market itself. Mastering what you've learned today is the key to identifying the right vehicle for wealth creation. Mastering the concepts in the next video is how you learn to operate that vehicle in the chaotic traffic of the financial world. The choice to click is not just about watching another video, it is a decision about who you want to become. Are you a passive consumer of financial entertainment? Or are you an active builder of your own mental arsenal? Are you content with a single tool, or do you intend to assemble the entire toolkit required for a lifetime of success? This journey is a deliberate ascent, and the next step is right in front of you. Complete the connection. Continue your ascent. Click and master the next piece of the puzzle.